Hi everyone, Neja here, and welcome to Stock Break, where I give an in-depth analysis on public companies in under 5 minutes, breaking down their fundamentals and potential valuation. Let's dive in. Hello everyone and welcome to new Stock Break episode. I hope you are all doing well. Today we are hitting play on Spotify. But before we do so, just a quick reminder that this presentation is for educational purposes only and it should not be taken as investment advice or recommendation to buy or sell any financial instruments. So Spotify, it's hard to imagine our life without it, right? The company was founded in 2008 in Sweden, and it has definitely revolutionized on how we listen to music and much more. Their library now offers more than 100 million tracks, 6 million podcasts, and 350,000 audiobooks, all available to stream anytime, anywhere. Now, if we take a look at their stock chart, we can see that Spotify had an impressive performance in 2024, and this raises an important question. Is it too late to invest right now, and is the stock overvalued at current levels? If we take a look a bit further back at their stock performance, the company went public in April 2018. And since then, they achieved a remarkable growth. But this didn't go without challenges, though, because we can see that their stock price dropped below IPO levels in 2022, but they managed to surpass those challenges with some strategic shifts, like rising subscription prices and expanding into audiobooks and podcasts. And this reflected in remarkable growth in 2023 and 2024. Now that we know a bit about what was happening with the stock in the past few years, let's take a look at their business model to see if their growth is sustainable. Looking at their business model, we could say that Spotify has built a strong freemium business model. That means that the revenue includes both premium and ad-supported revenue. But this premium tier, it is contributing the most to the net income, and we can see that it is contributing about 90% to all revenue. It is offering ad-free content, exclusive content, and offline downloads to their customers. And honestly, I can't imagine my life without it, but there is also a free tier, which is supported by ads, and it is attracting a wide audience. I would say that this free tier kind of works like a gateway to convert users into paying customers. Besides that, the company is also heavily investing into content like podcasts and audiobooks, and also in AI features just to keep users engaged. Besides just looking at their business model, it is always important to take a look at numbers. And the company released their fourth quarter earnings report in the beginning of February. And based on the numbers, we can say that their massive and growing user base is their key strength. The number the market focuses on the most when Spotify's reporting is monthly active users. And this number grew by 12% year over year to record 675 million in the fourth quarter of 2024. And their premium subscribers also grew by 11% year over year to 263 million. And both of those numbers were above their guidance. So this was a very good news for Spotify. Also, their profitability improved. If we take a look at their gross margin improved from 24% last year to 32% in fourth quarter of 2024. This report also marked the first profitable year for the company, and it caused the share price to pop by 13% after earnings. However, the success comes with higher valuation metrics. Their price to sales ratio is currently standing at 6.5, which is way higher than their historical average of 3.8, and their P ratio is just under 90, and their forward P ratio is standing at 48. This suggests that the stock might be overpriced at the moment, but at the same time, it is also saying that the market has high growth expectations from Spotify and that investors feel confident about their future growth, and they see potential that the Spotify will reach 1 billion monthly active users by 2030 and generate 100 billion US dollars in annual revenue shortly after. On the downside, competition in this field is fierce. Big tech companies can basically just add streaming into their broader services, making them more appealing to customers and putting more pressure on Spotify's margins. These companies also have deep pockets and they can afford to keep streaming costs low, which could make things a bit tougher for Spotify on the long run. One other concern is also that the company relies heavily on record labels, which could demand bigger cut of future profits. Now, according to Guru Focus, the stock is currently significantly overvalued with fair price of around $200 per share, which lines up with high valuation metrics and also with high market expectations. While I think that the company has a high growth potential in the future, I also think that investors should remain cautious at current valuation metrics. That's it for Spotify. Let me know what do you think about this music giant and which company would you like to see in the next episode. To stay ahead on all things investing, make sure to follow us on all podcast platforms, including Spotify. Just search for Digest and Invest. See you next time.